In today's video, I want to take a quick look at Bitcoin, and then I want to examine again the stock market. Um, Bitcoin just isn't my thing. I don't trade Bitcoin, but I think there's a lesson here that we can apply to the stock market bubble as well. I mean, this is clearly in another bubble phase. Bubbles tend to go straight up. However, as I've been saying, we're going to have at least one volatility event in the stock market bubble, and we just had one in Bitcoin. This was quite a large decline and very quickly into this correction, and then the bubble resumed. So this was the buying opportunity. I do think Bitcoin is going higher. I have no earthly idea where it's going to top. Maybe it tops here at 50, maybe it gets to 100,000. I have no idea, but I do know that this is the sign of a bubble. For one thing, price is moving straight up in a parabolic fashion. We're getting stretched extremely far above the 200-day moving average. I'm starting to see a lot of people making excuses for why the fundamentals are going to prevent any kind of correction. All of these things happen when you're in the middle of a bubble. Again, like I said, this volatility event, this is very scary when it's in progress, but these tend to happen as you start to get into the mature phase of a bubble. Bitcoin may have another volatility event and recover from that as well. What I can tell you, though, is that all bubbles pop. Fundamentals don't matter. All that matters is that as price starts to go vertical like this, you start to get a lot of unsophisticated retail traders that are jumping in, trying to, they don't want to miss out on any more of the move, so they're willing to buy at any price just to get in. And then at some point, the market just runs out of buyers. There's just nobody left. And so smart money starts to take profits. When they do, there's no buyers left. And then price starts to fall, and usually it falls pretty rapidly. And all of these late buyers that came in, under the false impression that the fundamentals would prevent this from correcting, all of a sudden these people start getting underwater on their positions. And then the only way to stop the pain is for them to sell, and that's that's what causes the crash. It's all of these late to the party, unsophisticated retail traders chasing a parabolic move, and then when the correction starts, they end up getting stopped out, and they have to sell to stop the pain, and that's what causes the crash. And a good rule of thumb is the further a bubble stretches above the long-term mean, the more damaging the crash will be when it occurs. And they almost always go well below the 200-day moving average when the crash happens. So, if the crash were to start at 50,000, it would probably, I would guess the crash would go down somewhere between 10 and 5,000. If this thing gets to 100,000 really quickly, then we're probably going under 300 or under 3,000 when the crash occurs. It's just the rubber band theory in practice. The further the market gets stretched in one direction above the mean, the more violent the regression is when the selling or buying pressure exhausts. All right, so now let me apply this to the stock market. All right, first off, I'm focusing on the NASDAQ. The bubble is going to be in tech, just like it was last time. It's always in tech. That's always the leading sector of any bull market. So you can see, this was our slingshot move. This has got everybody on the wrong side of the market. And then central banks start printing a lot of money. That money starts to push the stock market back up, and then we start to reopen. That improves the fundamentals a little bit. We get the first leg of what I think is our T1 pattern. We get our sideways midpoint consolidation. Now we're working towards what I think is going to be the second leg of the T1 pattern, which has a target somewhere between 17, 18,000. Although I will say in the latter stages of a manic bubble, the Nasdaq could go well beyond 18,000. So I wouldn't write that in stone that that's going to be the final top of this bubble. But I think we're probably going to at least get to 17 or 18,000. But we could go maybe even far beyond that. But anyway, so as we came out of this midpoint consolidation, we had a period here between the breakout at 12,000 and 13, where the market, the angle of ascent was pretty similar to what it was here, pretty steep, but still, some corrective moves along the way. And then we get a very small volatility event right here into a daily cycle low. This took almost 60, I think this is 61 days to get this. So very stretched daily cycle, which kind of makes me think this cycle might be short. But as I've been telling my subscribers, if we can get through 14,000 very quickly, then there is a chance that this daily cycle could just continue to launch straight up and make it to maybe 15,000 before we get our volatility event. I'm looking for something very similar to what happened in Bitcoin, something that really scares traders, makes them, in real time, it looks like the market is topped. So we could definitely see maybe, if we get to 15,000, we could maybe come all the way back down to test this peak here, maybe all the way back to 1350, a big volatile move down. It could happen very quickly in as little as 4 to 6 days. And then that'll be a buying opportunity. The first volatility event is rarely ever the top of the bubble. So, but I'm expecting something like that here soon. So we'll have to see how we close the day. If we can hold this breakout here above 14,000, then I think we may have opened the door for a buying stampede to take this maybe up to 15,000 before we get our first volatility event. And again, even that's not written in stone. Maybe we could go above 15,000 before we get the volatility event. But I think closing above this today at least opens the door to a very powerful and quick surge up to at least that 15,000 level before maybe we get some kind of a much more severe correction than what we just went through right here.